In today's video, I'd like to do a bit of a breakdown inside of the gold and silver markets, and we're going to use three different asset classes to do this breakdown. The first is going to be our futures market, the second is going to be our micro futures market, and then finally, the third is going to be our options market for the ETF. And the whole idea of looking at three different asset classes is to show you how nearly identical trade setups, same time, just two different markets, can result in different risk profiles and how you can use that information to then craft a strategy that works well for your account size along with your trading style. Now, let's get started first with our morning volatility note. If you're not familiar with this, I'll leave a link to a video which walks through a note in much more of a slower step-by-step process. But in today's video, we're focused in on gold and silver. So inside of gold and silver, both of those were on their aggressive volatility box model. The one takeaway from that, the piece of information you can gather, is we were not on the scalper, meaning we had broken past or out of one model's volatility. That tells you both of these markets, they're moving. There's something interesting there that might set up the fact that they're not on their lowest model, the scalper, but instead off of the aggressive. So that's your first hint. Now, if we move on to the actual trade setup from when it triggered, that was today, November 16th. The trade we'll look at was the breach at 10:48 a.m. Pacific. This is a breach of our volatility box clouds. You'll see a visual of that in just a second, but let's look at the numbers first. And this is a long entry. Now here I've broken this down in chunks of three. The first is the full size, then the micro, then the ETF options. Inside of silver, similar concept, the full size silver, the 1,000 ounce silver, and then SLV options. And we'll go through each of these step by step. So starting off first with gold, the margin required there per contract is $8,250. And with the trade setup that we were looking at, our risk was $140 per contract. That was also our reward, so 1-to-1 risk to reward ratio there. And if we take a look at what that 140 is as a percentage of that 8,250, that's 1.7%. So that gives you an idea of what gold looked like. Now we move on to micro gold, in which everything is really just 1/10 of the value inside of gold. So you'll see the margin 1/10, $825. The risk and reward as well, same thing, $14. Now, the advantage of having these micro contracts is you can scale in and out according to smaller amounts, which lets you meet your specific and usually smaller accounts value in terms of the percentage threshold. The downside, however, is the fact that you have to pay more commission, so keep that in mind. Now, moving on next, we have GLD options. The 173 calls expiring 3 days from now were the ones that we used for this experiment, and the cost of those options was $1.03 at the time of the entry. So your total risk there, 100% of that contract, given it expires in 3 days, so $103. Now, in terms of the value here that the GLD options returned, this moved a total of $8, which was 7.8%, and this does not factor in commission. So that's something you need to be wary of. Whenever you're looking at something like option moves this small, I think that plays a bigger factor. Now, moving on next to silver, where that whole commission idea will come right back into play. We start first with the full size contract. Here you'll notice the margin requirement is greater than gold, and so is our risk to reward, $200. The return percentage there was 1.6%, which if you remember inside of gold was 1.7%, so a little bit smaller. Same thing if you went inside of the SIL contract, $2,530 for your margin, $40 in terms of the risk for the trade today, 1.6%. And so both the micros equivalent along with the full size contracts, but that just gives you an idea of how you can scale in and out and the different risks associated with those contracts. Now the SLV options here I think is where the two ETF options become a little bit more astray. Here, the SLV options cost 24 cents at the time of entry, and these were the 23 calls. Same concept, 3 days to expiration. So total risk of $24. But they only moved $2, which while on that percentage basis looks nice, I think once you factor in commissions, this becomes a significantly less attractive trade compared to using the futures or micro futures contracts instead. So that's something to keep in mind. Now let's move on to taking a look at our actual charts. Now, starting off with gold here, our setup came when price action fell inside of our volatility box entry lines. That's the cyan line right here. We had that first breach. Once that happens, we're looking for this green arrow, which came across in this yellow candle right here. Once that green arrow comes in, we know that A, we have a volatility box breach. B, that's confirmed with the edge signal. We're looking for a reversal. our entry is at that same cyan entry line or better if you can get it, which in this case you did get better, but we're going to use the cyan entry line as our point of entry. The risk was 1.4 points, which is the distance between our entry to the outer edge of the clouds, and we're looking for that same amount on the opposite side. So that's the premise of the trade that we're discussing today. So price action fell inside of those lines. We had the green arrow. We had price really chop around there for about 5, 6, 7 minutes. And then from there, we ended up hitting our first target. That's all we got with the trade today, our first target. But if I move on to MGC, you'll see the setup is the exact same. Price fell inside of our volatility box cyan lines. We had the edge signal, the green arrow right here. Price gave us an entry at the cyan entry lines, and we bounced from there the same 1.5. Now, if I move on to silver, same time you'll see the breach happens at 10:48 a.m. Pacific. We have the edge signal arrow that comes 1, 2, 3, 4, and 5 minutes later. We then have an opportunity to enter the price better than the cyan entry line in this entire chop. And then price finally starts to get going. And if I shift this up just so it's easier to see, our risk was the same outside of the cyan entry line to the outer edge of the clouds, which was zero point 0.04 silver or SIL ticks. So that gives you an idea of how the setup visually turned out. And finally, SIL, you'll notice something similar, the breach, the edge signal, and then the reversal. So across all of these different asset classes, you had the same setup across really the same time, more or less, take place, and you had different ways to try and participate in that based off of whatever your account size allows for. So again, here's the table one more time that you can use just as your reference. Hopefully this helps you in terms of understanding how you'd like to scale in terms of both the risk and the reward you're looking at for the amount of capital it takes. Take care, everyone. Good luck trading, and we'll see you in the next update.